We're talking jobs numbers today and what that could mean for gold. Joining me today is Erik Norland, Executive Director and Senior Economist for CME Group. Erik, welcome back to the show.
Thank you for having me.
So let's look at those employment numbers with you. Below market expectations, the question is, the jobs market slowdown, do you see this continuing or can we expect a pickup again next month?
So I actually would beg to differ. I think it was actually a very, very strong number. It is true that the September numbers came in a little bit below expectations, but there was a big upward revision to some of the previous months. And in addition to that, we also saw the unemployment rate fall to just 3.7%. But looking ahead to coming months, there is one indicator that by itself explains about 60% of the month-to-month variation in non-farm payrolls, and that's credit spreads. Right now, credit spreads are just about at their tightest level that we have seen in over a decade. And that implies to me that it's very likely that we're going to see continued very, very strong jobs gains into the fourth quarter, which should keep the Fed on its tightening path.
All right. So I know last time we spoke, you foresaw the Fed remaining hawkish. So same for you now, Erik.
Yes, I think so. I mean, the Fed has made very clear in their dot plot they plan to go again in December, which the market is now more or less on board with, as well as 3 times next year and maybe once the year after. The market's partially on board with 2019. It's basically saying 2 rate hikes are priced and not 3. It's a bit skeptical about any further hikes in 2020, but I think at least now through the early part of 2019, we're going to see continued Fed tightening.
All right, so let's look at gold now, Erik. How can investors make money on the metal when sentiment right now seems to be so low?
Right, gold has been trading in this really tight trading range now for a while, around 1,200. And I guess the question is, what's going to break it out? And the most remarkable thing about the gold market right now is the strength of its correlation with the US dollar. If you look at gold's day-to-day movements and you compare those to, say, the Bloomberg dollar index, the gold is correlated with that at negative 0.6. So part of the reason why gold is in the doldrums is because the dollar is so strong. And a large part of the reason why the dollar is so strong is because the Fed continues to hike rates. So gold might remain under pressure for a while, but there is a longer term risk that could create a tremendous rally in gold. Maybe not soon, but maybe later in 2019 or maybe after the year 2020. Which is that monetary policy is pulling the dollar higher, but fiscal policy is pulling it back lower. We have a vast expansion in deficits in the United States. And if the Fed over-tightens and were to put the economy into a recession and then have to cut rates back, we could see a tremendous, tremendous bull market in gold. But at the moment, though, that's not in the cards for the next few months.
And Erik, what about the cracks, though, that we're seeing in Europe, most notably the issues coming out of Italy? Would that not have an impact on gold?
I think it is having an impact on gold, but I think the irony is this, that the problems in Italy, as well as the problems surrounding Brexit that are putting pressure to the downside on the euro and the British pound, are actually bullish for the US dollar. And anything that's bullish for the US dollar tends to be bearish for gold. So I think that you really have to look at gold here as a currency that's trending with the euro, the pound, the renminbi, and other currencies versus the US dollar.
Erik Norland, thank you so much for your thoughts today. Thanks for joining us.
Thank you.
And thank you for watching. We'll be back next week.